Good afternoon. This is Dave Muth, and I'm here on the webinar with Bruce Eisen, one of the partners in DST Farms, and Bruce Sherrick, professor from the University of Illinois. We're excited to have everybody join and learn a little bit about our DST Farms business, where we're bringing farmland as an asset class to the Delaware statutory trust space. We're going to start out and let Bruce Sherrick give us a little bit of background on the U.S. farmland asset class. This will be particularly useful for folks that may be with us that don't have quite as much background, to give some context on how farmland performs, what kinds of issues and opportunities exist. Then we'll move through and start to introduce our structure, what the Delaware statutory trust structure looks like, how we're focused on various opportunities in the farmland space with DST Farms, and we will talk a little bit about our first offering that's available, farm down in southeast Arkansas. So to get started, I'm going to go ahead and introduce and let Bruce Sherrick, Professor Bruce Sherrick, take over and give us some background on the U.S. farmland asset class.
Thanks, Dave. My role here is really quite simple. I'm just going to try to help level set, provide some information about the U.S. farmland as an asset class, and then let Dave and Bruce talk through how that can be actually kind of implemented through a DST structure. So to begin with, just to kind of introduce the scale of the asset class, U.S. farmland has a $3.1 trillion total scale on the balance sheet, if you will, of the U.S. ag sector. If we were to take all the farms in the U.S. and collapse them onto a single balance sheet, this is what it would look like through time. The chart here in front of you is organized from left to right, first in decades, and then some recent years, just 2 years at a time, to show the incredible growth in the asset class through time. And we have some charts and some other things to help justify how this happened. But to point out some really interesting features, focusing on the right-hand side of the 2020 column. Again, a more than a $3 trillion asset class, and yet there's very little actual debt in total. Now, individuals may have a lot of debt. That is very non-uniformly distributed across owners. A lot of farms have zero debt. Some farms have some debt, but a fairly under-levered asset as a rule of thumb, and about 14% debt-to-asset ratio. Again, I'm going to kind of speed through these. The content here in the slides will be available after the presentation as well at the People's Company website. So details, if you're interested, you can kind of look back through. But just to remind people that it's actually a very, very large asset class. The descriptive characteristics of that is, again, I have said, real estate accounts for 83% of the farm assets. That's a rather remarkable concentration, if you will, and there's only 14% debt. So it's a fairly low leverage asset class compared to what you might be thinking about in commercial real estate or traditional REITs. But that's just how it is. One thing to point out, though, is there's one very large fund. NCREIF has been around since 1991 and has put together a consistently accounted for and completely similarly managed set of properties from all across the U.S., and that's about $12 billion. So we'll have some returns data from that to kind of help show and justify what we think of when we talk about farmland at a more disaggregated level or state level. To this point, though, farmland is a really complicated asset class to make investments in. There's no simple way to go onto your phone app necessarily and buy and sell shares of agriculture like there is for Nike or JP Morgan or Apple or something. So we're trying to think about this also from the context of how does one get retail investment or above retail investment level capital back into the asset class. We also hear a lot, and if you read the popular press around agriculture, farm ownership is very much getting to the point where the transmission of assets to the next generation will be necessary, and there's some complicating factors in that. If you have an asset that has appreciated dramatically and you have a lot of heirs, it's a fairly complicated asset to deal with disposing of. And operators likewise are increasingly renting more of their land, so what I would call the market for operators seems to be fairly well developed at this point. Ag as an asset class, though, has some investment characteristics that are probably worth diving into at a little deeper level. We have seen what I would characterize as a continued and perhaps even accelerating interest in investors adding agricultural assets to their portfolios because of the historic characteristics of the asset class, and those include lower negative correlation with financial returns, no matter how you cut up the data period, and almost no matter how you assign your definition of farmland. You get the conclusion that the returns from farmland are negatively or at least uncorrelated with returns to traditional financials. That's important so that you don't have responses in ag returns that you get from things like macro shocks or trade shocks or conflicts, military conflicts, or major weather events around the world that you quite often see registering in the financial markets, or recently when you have an announcement from the Federal Open Market Committee, how you may see bond markets move completely, within a few days, give back or make up or accelerate returns, in 2 or 3 days equal to what you might have had in the previous month. Also, farmland has generated historically what we would call high alpha or more return than justified by the degree of variability in returns. But it's honestly quite difficult to capture. Again, if this were an easy asset to trade without some kind of professional acquisition, management, and disposition, then we would expect perhaps that alpha to disappear. But it's persisted because of the complexities and fairly low turnover, thin market characteristics of the farmland market. Finally, super high correlation with inflation through time. That's been a little bit muted in the last decade because we haven't had as much inflation, of course. But we can do an analysis that pretty much confirms that it remains correlated with inflation, even when inflation regimes or epochs change quite a bit. So this chart will take a little bit of time, but it's kind of one of the meatier things that I wanted to go over. What I've done here is just collect a set of different assets or indexes, starting from the top. If we took the top 32 states in terms of their value of agricultural production and combine them into a single asset, we call that the U.S. Ag 32 State Index. NACREIF, as I mentioned before, National Council of Real Estate Investment Fiduciaries, has a $12 billion total aggregate value in farmland. And we can look at that, we can subdivide that into things like row crops, permanent crops, western, northern, southeastern, and so on. But it's just taken as a total. And then Arkansas, because one of the properties that's going to be talked about a little bit happens to be in Arkansas. A few financials or indexes of financials for the S&P, New York Stock Exchange. ETH is just the East Asian Far East Index. A lot of people would like to know what exposure to ex-US, in particular China and China Rim, might suggest. MSCI is the Morgan Stanley Composite Index, US stocks, equity REITs, just to think of another real estate style analog, AAA bonds, 10-year treasury rate, average rate on 30-year fixed rate mortgages. The CD 6-month is a 6-month CD, gold, because people think of it as a bit of an inflation hedge perhaps. Producer price index and the consumer price index. Second column, standard deviation, or the variability in that average annual return. And the average annual return is on a geometric, so you can link it through time and get the right numbers with pluses and minuses for the technical issues behind it. The standard deviation, the variability in that annual return, coefficient of variation, just standard deviation divided by annual return, or risk per unit of return is how we would probably think about it. The last two columns, minimum return and maximum return, just show the smallest and largest annual total within that last 2-decade period. Moving back now, the correlation column is just to show the degree of relatedness with respect to the total ag index return that we've constructed for the 32 states. So farmland tends to behave as an asset class fairly uniformly, and in particular by region or crop type. So you would expect the returns in Illinois and Iowa and Indiana and southern Minnesota to kind of move together. And you would expect that Arkansas, again, would move like other farmland investments, and we see that that's the case. The next set of negative correlations, just to begin to punctuate the idea that it provides a good investment hedge against traditional equity investments. Moving down the list a bit more, all the way down to inflation, what we typically find is that farmland provides a reasonably strong inflationary hedge, especially over the long period of time. Again, we can look all the way back into the 70s, we can look at sub-periods. That relationship, when inflation is higher, tends to get stronger, and when inflation becomes stable and near zero, the correlation tends towards zero. But nonetheless, we would expect if inflation returns, that farmland would continue to behave as it has in the past. Now, this is a really busy pair of pictures, I realize, but I think it provides a really powerful story about this variability question. Now, the NASDAQ, you can trade stocks every day, every hour, every couple minutes if you wish, and you can change the period of time over which you're exposed to the returns pretty much at will, start and end at any point in time. With agricultural assets, the income cycle tends to be annual, and so there's a little different kind of idea here, but what we have done in this pair of graphs is to simply say, if we were to annualize the returns, and instead of just looking at last year or 2 years or 3 years, we looked all the way back to the early 90s and said, what if you bought at the beginning of the year and sold at the end of that same year? What would your return experience have been? So that sort of diagonal stair-step pattern down from top left to bottom right is the 1-year holding period. You know, buy at the date on the left-hand scale and sell at the date on the top scale. And 1-year holding period is the return you would get down that stair-step. Left-hand side is Iowa farmland, right-hand side is NASDAQ, kind of an index composite of especially smaller stocks, tech stocks, and so on. And start with 1990 because that's also the period that NACREIF was, began to be published and began to show returns. What's important is not necessarily the numbers, but the patterns and colors that you might see, and then the insert graph, how many times you're above or below zero. And very importantly, though only going to give this sort of in a colloquial description, if you can see horizontal or vertical stripes, then there's persistence. You made a mistake that lasted a long time, or you got lucky in a way that lasted a long time. So if you had bought right before the .com or right before Black Monday or right at 2008, it takes you a while to get back to zero in the equity markets. And the number of times you can penetrate that surface and have a negative or an actual loss in capital kind of shows up in the equities pretty frequently. But if you do well, if you happen to buy it exactly the right day and sell it the right day, you can do very well. Farmland has a much smoother returns pattern. And as you move away from the diagonal stair-step, the deeper into that chart you go, the longer your holding period. So to look at a 2-year holding period, you would move 1 step above the stair-step, the 3-year and 4-year and 5-year, all the way out to buy in 1990 and hold clear through the end of the era. You'd have the number in the top right corner of this triangle buy-sell surface, which is the numbers we reported to you on the previous page. So the Iowa average is that top corner, you know, the longest holding period possible given the data set. But what I think is important is we don't always hold everything forever. Sometimes we have a reason to need to sell. Sometimes we have an impediment to sell it. Sometimes we have an impediment to buying. And so this pattern would show you for any possible combination of holding periods what the returns level and variability would be expected to be. The middle section of each of the graphs, again, won't spend a lot of time going through the technical detail, but it is a pretty direct and standard statistical technique for saying how fast do the statistics I calculate converge on their best value based on how many years of data we add. And what we see is that farmland returns pattern is to some degree fairly stationary, to use the term a little bit inaccurately, but that we have a fairly quick cabling up or convergence in what we know based on what time period we looked at. If you look over on the NASDAQ side, what it basically says is anything can happen at any point in time. If you put those two together, they tend to offset each other in a meaningful way. let's look at farmland from a slightly different perspective. And if we said, what about a 3-year rolling average? So think of 3 boxes above and to the right of that stair step. If on average I was holding my farmland for 3 years at a time, how would it compare to these other asset classes in terms of the correlation? Well, I'm going to start at the bottom and kind of work up. U.S. Ag 32 states is 99.5% correlated with all states in the U.S. because once you get past the top 32, there's not much more information in the remaining smaller states. So, Connecticut may not have a lot of agricultural production. Adding it into the list after the top 32 won't change things. PPI, or the Producer Price Index, highly positively correlated on a rolling average, as is the CPI, or what we think of as consumer version of inflation. Gold and fixed incomes also tend to have positive correlations. Here, though, as you go further up the chart and you find out the Dow, S&P, and the EVE, what we think of as meaningful equity indices, farmland, again, looks like it would be a good place to park money to have diversification benefits if that were your goal. This one's a great chart from my perspective because, and it again, it plots several data points from NACREIF in particular to just say, through time, what has been the volatility and the average return on just a direct, what we think of as an EV curve, or a expected return and a volatility curve. And what we, I think, notice here is that farmland tends to be left and above many of the other assets that we might think of. And that's important because what we want is to move left, have less volatility, and move up or have higher average annual rates of return. NACREIF permanent just separates out permanent crops, NACREIF total for all crops, and then NACREIF farmland for just row crop and annual farmland. Okay, so what is the appropriate discount rate for ag, though? And I guess I'm not sure how to think about that myself, but what I will point out in this graph is that the annual first yield curve from each year from 1918, 1919, and 2020, 2018, 2019, and 2020 are the solid lines at the top, and we had short rates at 1.5 and long rates maybe getting close to 3% for a long time, and we thought of that, frankly, as a low interest rate environment. Little did we know, at the beginning in March, we would have kind of a dramatic reversal and a reduction in cap rates. The dotted lines are just 3 different months, 3 different quarterly indexes for Treasury yield curve in the U.S., different dates. And again, what the question that raises is, what is the appropriate discount rate for ag? For a very long period of time, we tended to use the 10-year rate, and we used it in the following 2 ways. And I'm getting near to the end of the kind of introductory materials I wanted to provide, but these 2 graphs are incredibly powerful in my mind. The one on the left just says, what was the 10-year Treasury rate through time? So the dotted line, and you see, and some may even recall in the 70s, interest rates, nominal interest rates skyrocketed, mortgages close to 20%, treasuries 15 to 18, inflation close to double digits, and we had this departure in value between interest rates and the amount of income that you could get from investing in farmland. So the solid lines just represent 3 states where cash rent is a fairly common way of controlling or earning your return from farmland. If you're a farmland owner, renting it creates an income number. If you're an operator, you can think perhaps of the rent as being income to somebody else. And if you owned it and couldn't make as much as you could by renting it, it at least creates an index of opportunity cost. So if you take the rent to value ratio, or the current income divided by asset value, you can think of what the, in a sense, implied cap rate was for farmland, and it tracks very well with interest rates, except for that period in the 80s. And in that period in the 80s, we had, quite honestly, the perfect storm. We had a oil crisis, we had a grain embargo, we had a hostage or a trade disruption because we had an international military crisis as well. That was a period of time that also had lenders lending maybe up to 80%, fixed rates of 20% interest, on an asset that was not going to inflate fast enough to pay back. The only other time in history where that came close was essentially 2009, which was not really an ag crisis, it was just an economy-wide crisis. Moving to the chart on the right, very different, and why I include this one is it shows on the right that farm expected income. Way to interpret this. If you were to, as I said, follow those dotted line cap rates down from the previous slide, you would have gotten an implied multiplier on income that was just exploding, right? Well over 100 if you have an interest rate less than 1. So I think this gives us a very strong signal of the rationality of farmland markets. It tells us what cap rate farmland actually thinks is appropriate. And I think this is one of the great punchlines because it can be done with all seriousness or almost tongue-in-cheek to say, who thought that 3% was ever going to be a high yield? For years, we talked about farmland as being, yeah, it's a great fixed income, but maybe 3 to 5% cap rates. And now, 3 to 5% fixed income cap rates don't sound like a small number anymore to many investors. So with that, I'll turn the presentation back to Dave, and he can begin to introduce the DST farm information.
Perfect. Thank you very much, Bruce. So that's really good background, particularly for folks that may not have quite as much history with the farmland asset class. Sort of bottom line takeaways, competitive returns with unique stability over time. I wanted to let folks know too that we've got quite a few people on the webinar, so if you want to ask any questions, we'll have a Q&A session at the end, and Bruce Eisen will help us with this and getting into any technical details. Please go ahead and use the webinar system to put some questions up there, and to the best extent possible, we will try and address them here in the webinar. So a quick introduction to how DST Farms came to be. Steve and Bruce have been working together on a number of projects over the years. Steve building out a national scale farmland real estate transaction company and people's company, and Bruce working in farmland investing and having some knowledge and background in Delaware statutory trusts. And over time, it became really clear that there was an incredible synergy where the Delaware statutory trust market could very much benefit from the farmland asset class within that marketplace, and the farmland real estate transaction business could benefit quite a bit from having a Delaware statutory trust as a vehicle for bringing capital into the asset class. So through this process, DST Farms has been developed, and that's why we're excited to sort of roll out to people today. In order to make the platform work, we need a number of strong partnerships to help execute all components. People's Company is our farm management partner who handles all of the professional management services with a proven platform. And also helps us with a lot of deal flow. People's Company has a national presence, boots on the ground across all of the major agricultural regions in the country, so we can quickly help identify deals that make sense within the DST structure. North Capital helps us with verification and investor identifying if investors can work through the system. CLA is our partner for handling all of the accounting. WealthBlock is providing our back-end digital system for delivering the offerings and the documents to our partners. And McLaughlin Quinn is a legal partner to help make sure all of the structures are in place. So a little bit just characterizing the services. It's a 1031 exchange service, bringing access to farmland assets with a low minimum entry point. Okay, so we've got the back-end system that can help provide a streamlined and secure technology-driven process for investors to work through. And then we've got all of the professional management services required to make the farmland asset work. When we think about it in the context of landowners, it's a unique opportunity for providing a committed equity source for landowner operators that may want to grow, or we can bring unique and creative deal structures in for landowners that might want to do long-term sale leasebacks. And then also it's a unique instrument for family transitions, which is an interesting demographic issue that we'll talk about briefly here in just a little bit. So quickly wanted to just give a little bit of background on Delaware statutory trusts in the current marketplace. It's about a $3 billion marketplace, primarily driven by commercial, multifamily, residential, some industrial office storage types of assets. Returns are very much driven by cash yields, and typical return profiles work in that 5 to 10%. So it's robust. There's a lot of transactions that happen, and it's an active marketplace on an annual basis. Thinking about it in more technical terms, DST is a single-purpose entity that will sell and hold the real estate assets. It's legally recognized. The professional management side of this is really critical to make these structures work. The business activities are conducted by the trustees, and the trusters are entitled to that beneficial interest. It is a replacement asset for a 1031 exchange, very critical component of being able to work in the marketplace. We can find a number of different income distribution models depending on the assets and how a particular deal is structured. And all capital distributions are eligible for subsequent 1031 exchanges coming out of a DST. Now, thinking about DSTs as an instrument for 1031 exchanges, which, as I expect most folks know, but is a tax deferral mechanism for reinvestment of that appreciated capital into a real estate portfolio. The DSTs are existing offerings that are out there that create a simplified identification process. Another component that's pretty important is it's not often easy to take that 1031 exchange money and find an asset of the exact same size and scale. And DSTs can offer scalability so that reinvestment, that exchange, can actually consume all of the capital that is trying to move through the 1031. Because the DSTs are already purchased and existing, that removes the closing risk. That's another challenge that can often happen in 1031 exchanges. And that creates a really powerful kind of backup plan if it's not the first step, the first goal for a 1031 exchange investor. Thinking about farmland in the context of some of these DST advantages, there's several similarities, right? Well, long-term triple net lease, that's part of all of the structures with kind of more traditional multifamily or commercial DSTs also. Non-recourse debt as part of the structure, absolutely. Low entry point, $100,000, sometimes a little bit more or less, creating access to larger assets. Certainly a component of all of the DSTs. Now, some things that are potentially a little bit more unique to farmland. Typically, we're going to deal with a single tenant in these farmland DSTs. Farmland has effectively 0 vacancies on an annual basis. We can get a portion of the annual rent paid in advance. Now, a really, really critical one that's very, very important to our strategies. In U.S. farmland, there is a federally subsidized crop insurance program that can create a minimum annual revenue guarantee for the farmland operators. This is an incredible hedge against risk of revenue drops on an annual basis, and it's the only investment-grade asset class in the world that has such a strong guarantee for annual cash flow. Typically, farmland, there's going to be no structural repairs outside of potentially some irrigation infrastructure, or in some cases, there may be some structural components to farmland or DST assets. And then we also have the ability to create some upside potential within our lease structures based on enhanced productivity, enhanced market dynamics that are a little bit unique. And farmland can also provide some really interesting environmental externalities and social responsibility types of investment outcomes that are pretty interesting. Okay, I want to talk just a little bit about some interesting opportunities in farmland that are core to the strategies that DST Farms is working on. One of the things that we're very much focused on is right now consumers are showing a strong trend towards wanting a deeper understanding where their food comes from. This manifests itself in a few different contexts. The organic label is certainly one that provides some of that desire to consumers, and it shows in premium pricing. Typically, crops produced organically are going to be between 2 or 3 times the market value of crops produced conventionally. And we see that trend holding for quite a long period of time. Right now, about 80% of the organic soybeans that are used in the United States are imported, and about 60% of the organic corn from places that it's hard to imagine can produce these organic crops more effectively than we can. And we see that trend continuing where consumption is growing at a faster rate than production. So we're excited about organic, but also just looking at traceability and overall sustainability within our assets can create some really interesting marketing opportunities for us. Another really important piece is technology, right? And what we're showing you here is the growth in national corn yields since the early 1990s. And it's candidly quite staggering, right? And this comes in the form of a lot of different kinds of technology. Biotechnology within the crops and plants, certainly technology in terms of management systems and equipment. And these trends are continuing. So we continue to see the ability to produce more per acre within the United States, and these investments are very robust, and this curve is going to continue, and it's spreading out to more and more crops consistently. That's creating a lot of the upside. This is a big piece of a lot of the data that Bruce showed you around the stability of the asset class, is we continue to innovate to be able to produce more with less efficiency and better. The other thing that's kind of interesting within the farmland asset class is we have some incredible demographic trends. Right now, about 82% of the land is, or landlords are 55 years or older, and about half of those are actually 75 or older. We will see some transitions happening. This comes back to the DST offering and ability to structure deals being pretty useful within this kind of transition environment, being able to work with multiple heirs that might have conflicting objectives with what they want done with the farm. And Bruce mentioned it too, the leverage is quite low, right? So there's going to be a little bit of an acceleration of deals within the farmland asset class due to these demographics. And the DST structure is uniquely positioned to be able to help provide solutions in some of those cases. Okay, so now I want to move just a little bit into the strategy that we're deploying within DST Farms. It's a pretty typical DST structure. The trust owns the assets, and the investors get access to the shares through the trust. Sponsor and signatory trustee works with the trust to get a master tenant in place with a long-term lease. There's going to be a non-recourse bank loan with a seller note that carries until the investors consume the available shares. We'll need to put reserves in place, particularly with assets that have the potential for some deferred maintenance, like some irrigation systems. And it's a triple net lease structure with the master tenant, and identifying that long-term profitability of that master tenant is really a critical piece of getting a good DST structure in place. Core strategy elements. We're really focused on this value-added crop production. And certainly organic is a big piece of that. There's multiple components to being able to execute that strategy too. That gets into scale, that gets into dedicated efforts around marketing and developing market outlet relationships that can find that premium value. The notion of sustainability and social responsibility in the investment comes from a couple of different directions. One, we see clear patterns in the marketplace that you're going to have to demonstrate effectively sustainable production in order to maintain access to the supply chain going forward. Plus, there's a very internal component, thinking about sustainability in the context of soil health and improving productivity over the long term. The federal crop insurance program, we diligently use that program to help protect revenue, and we make sure that the business plans associated with every asset are taking advantage of that revenue protection. And then having the People's Company Land Management Platform, which is a proven system that's working across the country to help manage our assets and develop and execute our business plans, is really a critical component of making DST farms work. We're very much focused on the reality that farmland as an asset class has two sources of return. The annual cash yield, typically the smaller of the two sources of return, which is a little bit unique. It's a nice complement to the existing DST marketplace in that 3 to 5% range if we look over long periods of time. And then the capital appreciation, which is the larger piece of farmland asset class returns. And this is where the management strategies, the sustainability, and understanding those components are really critical in order to make sure we're maximizing over the long term that larger component of our investment return. Now, with the sustainability commitments, we are actually all acres within DST farms assets are committing to a third-party sustainability certification called Leading Harvest. Leading Harvest, I would encourage folks that are interested to go look at Leading Harvest. It's been developed by several of the largest landowners in the U.S. and the world to create a landowner-focused sustainability standard. And you can take a look at the 13 primary principles driving the standard. But this is an incredible way to have a certified, audited standard brought out to the marketplace for the marketing of our crop production, and also ensuring that we're maintaining asset value and helping it maximize that appreciation on a go-forward basis. Okay, now I want to hop in and introduce our first asset in the marketplace. It's through Delta Organic Ag Properties, DST. We call this the Press Farm. This is in the very southeast county of Arkansas. It's just over 1,100 acres with about 900 annually in crop production. This is an area of the country that is typically quite wet through the late fall and through the winter and into the spring, and then it'll get very, very hot and dry in the summer. And so having the ability to effectively manage water and deliver water to the crops is really critical. So this asset's unique, and we were attracted to it as a DST opportunity because we have some of these unique characteristics. There's over 100 acres of freshwater reservoirs on the asset. And upon working through the deal, we found that the irrigation system is what they call a tailwater recovery system, where water that's distributed to the crops has the opportunity to be recaptured if it's not used and pushed back into the reservoirs or right back into the system to distribute to the crops again. As we worked through the asset, we found a number of things in the process of the deal that were improvements to make to the irrigation system, including getting electric power out to all of the systems, being able to improve some of the facilities and create some additional revenue opportunities through a hunting lease program. And we've been able to get started understanding and verifying the crop production, which is going to primarily be organic corn, organic soybeans, and rice. We'll have some winter wheat opportunities, and also looking at some organic popcorn opportunities on the asset. Crop rotation is very, very critical in organic production, and so we need to make sure that we have the rotations and the sequencing of crops set up, and these are all crops that have an opportunity to be highly profitable and can be protected through that federal crop insurance program. And another really strong aspect of this farm is there's a lot of local poultry production, which gives us affordable access to organic fertility. And so we don't have to worry about shortages in fertility, and that creates a strong benefit from a location standpoint. So a little bit more into the details of the investment. The asset was purchased in March of 2019 at $5.83 million. There was a $2.9 million non-recourse senior debt that was applied, and we've got and then a seller note that has been negotiated relative to some of the irrigation improvements that I mentioned previously, to $2.5 million. Okay, we've established the reserve accounts necessary for any potential deferred maintenance or repairs that pop up over the course of the DST lifespan. There's a 10-year lease in place with a master tenant that generate a base rent of 3.5% annual cash yield to the DST investors. We expect through our bonus rent provisions to be able to see solid IRRs and 4 to 6% annual increase in the farm value over the 7-year lifespan. A little bit closer look, syndicated value of this farm is at $6,419 an acre for an overall value of about $5.565 million. The offering size that's available is $2.65 million, minimum investment of $100,000. The projected IRR for the investors based on the base annual cash yield and the appreciation is 9%, with a base projected cash-on-cash return of 3.5%. Now, one of the important pieces of this investment, and we mentioned this earlier, is the ability to generate bonus rent with additional increases in production, in crop production, and crop value. So finding higher value markets, producing more crops, and getting some growth in those market values of those crops create a long-term upside to be able to get some bonus rent. And that's built into the pro formas. Certainly we will work on just the base level rent, but the annual cash, the bonus rent opportunity, if we look at it on a pro forma basis, using our business plans and our expectations, should grow to some really solid annual cash returns along with that appreciation. And all of these documents are available through the website and the platform to be able to study in more detail the business plan and how we expect to get there. So the primary strategies we're deploying on the Prus farm is, again, this diligent use of the federal crop insurance program. And it can't be overstated how important this is in the farmland asset class and for DST farms. Certainly on this asset, one of the recent hurricane remnants dropped more water than we want, and it's quite possible that we'll have some crop loss, or at least quality of crop loss, and we have that crop insurance buffer to ensure that the revenue on that subset of acres that may be impacted is still there for us. Value-added organic crop production with real focus on marketing that crop in an aggregate way across a lot of the work we're doing to some value-added marketing outlets also. We've talked a lot about that focus on sustainability. It's both for maintaining access to the market and then also maximizing that value to the investor, annual cash and long-term appreciation. And then the farm management platform, that People's Company is providing for us is an active farm management approach that's consistently and constantly working on some optimization of the farm practices that are in place. I would invite everybody that's interested to take a look at our detailed business plan, but summarizing a little bit of how we look at this hold period. The first year, there were several farm enhancement activities. We talked about some of those irrigation improvements. We're into the years of yield optimization where we're really understanding the soils and how to manage those soils and improve the soil function. And we'll move into, with stable crop production, into a fairly active crop marketing window where we can create that maximum value for the crops that are produced. Just a little bit of background to close out on how you go about looking into these assets and investing with DST Farms. So for folks that are interested, visit dstfarms.com and create an account. And you can access the offering and view all of the offering documents that are available. In the process, if you're interested to initiate an investment, there'll be an identity verification step. North Capital will do an accreditation status check, and then you move to signing a subscription agreement. At that point, all of the specific closing instructions, working with your QI or accommodator in order to actually facilitate the 1031 exchange process, remitting payment, closing on the investment, and then all of the requisite documents will be distributed post-closing on the investment. It's a streamlined process. We put a lot of effort, and our partners in building the platform have created some great tools to be able to execute. So with that, that gives everybody a little bit of background on DST Farms and our first offering. I'll pop up here and see if we've got any specific questions, and we can engage Bruce. Bruce, are you available to us for some questions?
Yes, Dave, and thank you for that wonderful overview.
Excellent. So one question we've got here, does the flow of imported organic products establish a ceiling for the cost that domestic products can hope to expect? So this is an interesting dynamic, and we didn't go into a lot of the details on this right now, but I'll give you a little bit more background. The importing of organic products are from places like Hungary or Turkey or Kazakhstan, various areas where it's fairly clear that an ability to produce organic crops better than we do here just doesn't exist. It's fairly widely known that a significant amount of these imports are fraudulent. And I think it's been about a month ago now that USDA, within their organic certification standard, just released a new set of processes to start to crack down on those foreign imports. So when we put that all together, what we know is that organic production is not easy. It requires good equipment, good processes, and good agronomic standards. And we're going to see a lot of pushback on imports, and it's not hard to look and see some loads, some barges, ships that get rejected recently over the past couple of years because they've been identified as non-organic. And that's certainly going to be part of the equation. Bruce, I see you raised your hand.
Just letting you know I'm here. Comment on the imports. I think it's somewhat of an anomaly to understand that the largest agricultural exporter, the largest agricultural producer in the world is actually importing organic grain. And some of that organic grain is suspect in terms of its actual certification, and the USDA is actually looking at some of those producers outside the country. But I think in the end, the bottom line on organic products will be developed in the United States. There's a shortage of organic land. There's demand for organic products, so we anticipate that organic prices will continue to rise, and the price of crops at the farm level will continue to rise, which will enhance farm income, and especially as international exports are vetted, and many of those are coming from countries that are suspect, like Romania, Turkey, Ukraine, and we will probably be meeting our own domestic needs in organic within 5 to 7 years. But that is a big window of opportunity, I think, for U.S. producers to expand into organic production. We continue to see organic prices to be 2 to 3x that of conventional prices. And so land that does produce organic should have higher farm income and higher profitability.
Thank you, Bruce. I've got another question here. I'll respond a little bit first, and then Bruce, please chime in. Do we have permanent crop opportunities with DSTs? The short answer is we don't have any offerings in permanent crops now. It's an interesting dynamic when you think about reserves and capital structures required within the DST framework, and some of the risks that can come with permanent crops. Is it possible to put a DST together around a permanent crop? I believe the answer is yes, but the short answer to the question is we don't have any specific permanent crop opportunities in our pipeline right now. Bruce, do you have any other thoughts there?
I think in the future we will be able to bring some permanent crop opportunities. I think Dave makes a good point that we do need to understand that there's maybe a higher cash yield on permanent crops or cash flow on an annual basis, but there's certainly issues with long-term capital surfacing those type of farms that make it a little more complicated. But I think that in the end, permanent crops are suited for DST structures.
Bruce, I've got a question that I'll pass over to you. Does this investment mechanism make sense for investors that are not transferring from one 1031 exchange to the next?
I'm sorry, can you, I lost you there for 1 second, Dave. Can you repeat the question, please?
You bet. Does this investment mechanism make sense for investors that are not transferring from one 1031 exchange to the next?
Absolutely. We are structured to provide 1031 exchange investors with a vehicle that allows them to defer their taxes, but for direct investment investors, we certainly offer an opportunity for both cash flow and growth. So it's not a requirement to use money that comes from a 1031 exchange to invest in the offering. So if anybody is interested in a direct investment in the offering with capital that is not 1031 based, we certainly can accept that.
Thanks, Bruce. Please feel free to put any other questions out there. Right now, that's sort of our list of questions. I think we're getting close to the end of our time here. We did just have another question come in. 1 second here. Bruce, here's another question for you. At the 100K minimum investment entry, are there options for pooling into a group investment package?
The issue really becomes a chain of title. So if you're doing 1031 exchanges, you would need to be able to have money coming out of a 1031 exchange going into a DST with the same title. Otherwise, you may lose the benefit of your tax deferral. So that's a complicated issue. If you're asking if there's possibility of lower minimums, there can be exceptions. But I think it'd be challenging to try and put 3 people together and stay qualified for the 1031 deferral.
Excellent. Bruce, did you have any other thoughts you wanted to put out, as we look at closing out?
Well, I want to thank Dave and Bruce. You guys did a wonderful job in presenting the asset class and also the opportunities in farmland. And I think that people should be aware that farmland is probably an undervalued asset, certainly under-accessed asset in the marketplace. And it has not gone through sort of the corporate consolidation period, and most farmland is still in private hands. It's under leveraged, and as it gets into either more investors' hands or institutional hands or corporate hands, I think the true value of farmland will be realized, which could be a substantial multiple of what it is today.
Hey Bruce, we did have a follow-up question to your previous answer. What are those exceptions for lower entry amounts?
Well, it could have to do with boot. So if someone has an excess on a farm place, on an asset placement or property placement, and they come to us and say, well, I've got $73,000 here boot that's left over. I'd like to place it. That's one of the things that DSTs can do, is to help investors place boot, which is sort of the odd capital out when they do an exchange. So if someone does their own 1031 exchange and they have identified a specific property and the assets don't match up perfectly well, the money that's left over we call boot, and we certainly would look at that on an individual basis to try and accommodate an investor in that case.
Excellent. So for anybody that would like some follow-up information, feel free to go through go to DST Farms. You can find contact information as well as the current offering and some more background information. And we would love to hear from folks and work with anybody that's interested in trying to engage the asset class through this DST structure. And I think with that, thank you all. Oh, did we just have another question come in? Oh, I also wanted to do one, Molly, it's good to remind me here. One last plug for the People's Company Land Investment Expo in-person conference, incredible meeting. Go to landinvestmentexpo.com, in-person January 12th of next year. Excellent meeting every year, and we would encourage folks that want to learn more about the farmland asset class to come to the expo. With that, appreciate everybody's time and look forward to hearing from you. Thanks.